Investing can be a great way to grow your wealth over time, but it's important to approach it with careful consideration and strategy. Here's a basic guide to get started. Understand the basics of investing. So, what is investing? Well, investing involves putting your money into assets like stocks, bonds, mutual funds, real estate, and so on, with the expectation that they will grow in value over time. Now let's talk about risk versus reward. Higher returns generally come with higher risks. Understanding your risk tolerance is key to making smart investment decisions. Set your financial goals. Are you saving for retirement, a house, or maybe a vacation? Your investment strategy should align with your timeline and objectives. And don't forget about an emergency fund. Before investing, make sure you have an emergency fund, ideally 3 to 6 months of living expenses for those unexpected situations. Know your risk tolerance. Risk tolerance is how much loss you can withstand in your portfolio without panicking or making emotional decisions. Younger investors might have a higher risk tolerance since they have time to recover from market fluctuations, while those closer to retirement generally prefer more stable investments. Start with the basics. Let's talk about stocks first. Stocks represent ownership in a company. When you buy a stock, you own a small piece of that company. Stocks tend to have higher potential returns, but come with more volatility. Next, bonds. Bonds are loans you give to a company or government in exchange for periodic interest payments. Bonds are generally less risky than stocks but also provide lower returns. And finally, mutual funds and ETFs. These are collections of stocks, bonds, or other assets offering diversification. Mutual funds are actively managed, while ETFs, or exchange-traded funds, are usually passively managed and trade like stocks. Alright, so let's talk about diversification. Diversification means spreading your investments across different asset classes like stocks, bonds, and real estate to reduce risk. Essentially, it's about not putting all your eggs in one basket. Next, let's discuss asset allocation. This is about deciding how to divide your investments between different asset classes. For example, a common allocation for a young investor might be 80% stocks and 20% bonds. On the other hand, someone closer to retirement might have 60% bonds and 40% stocks. Moving on, let's choose your investment accounts. If you're investing for retirement, you might want to look into tax-advantaged accounts like a 401k if it's offered by your employer, or an IRA, which stands for Individual Retirement Account. These accounts offer tax benefits that can be quite advantageous. Alternatively, if you want more flexibility and don't mind paying taxes on capital gains, a taxable brokerage account could be a good option. It really depends on your financial goals and needs. Finally, let's decide how to invest. If you prefer a hands-on approach, you can go the DIY or do-it-yourself route. Open a brokerage account and select your investments. Many brokerages now offer commission-free trading, and you can choose from individual stocks, ETFs, and mutual funds. If you prefer a more hands-off approach, robo-advisors might be the way to go. These are automated platforms that create and manage a diversified portfolio for you based on your goals and risk tolerance. Some well-known examples include Betterment, Wealthfront, and Vanguard Digital Advisor. And hey, if you're unsure about where to start or have a complex financial situation, consulting with a financial advisor can be a wise move. They can provide personalized advice tailored to your unique circumstances. Start small and be consistent. One effective strategy is dollar cost averaging, or DCA. This involves investing a fixed amount of money at regular intervals, whether it's monthly or quarterly, regardless of market conditions. This approach helps reduce the impact of market volatility and lowers the average cost of your investments over time. Even if you can't invest a lot at once, making regular contributions, like through automatic transfers, can lead to significant growth over time. Stay educated and monitor your investments. Read books, watch videos, and stay informed on investing topics. Understanding market trends, different asset classes, and the economy will help you make informed decisions. It's also important to review your portfolio regularly to ensure that it still aligns with your goals. Over time, you may need to rebalance your portfolio if some investments grow faster than others. Stay patient and avoid emotional decisions. Investing is typically a long-term endeavor. Don't get swayed by short-term market fluctuations, and avoid making drastic decisions based on fear or greed. The longer you invest, the more you benefit from compounding, earning returns on both your initial investment and any reinvested earnings. Types of investments you can consider. These include stocks, which are individual companies, ETFs or exchange-traded funds, bonds such as corporate or government bonds, and real estate, whether through direct property investment or REITs. If you're comfortable with high volatility, cryptocurrency is another option, along with precious metals like gold and silver. When it comes to tools and platforms for investment, you have brokerages like Charles Schwab, Fidelity, and TD Ameritrade. There are also robo-advisors like Betterment, Wealthfront, and Vanguard Personal Advisor. For real estate, platforms like Fundrise or REITs are available, and for cryptocurrency, exchanges such as Coinbase, Binance, or Kraken can be used. I hope this helps clarify the process of investing. If you'd like to discuss specific strategies, account types, or have any questions, feel free to ask or leave a comment below.
Thank you for watching. Kindly like, comment, and subscribe. Click on the notification bell so you can be alerted anytime a new video is uploaded. And please, don't forget, share and be a blessing to someone. God richly bless you. Shalom.